The screen. Got that. Okay. So I'm going to go through just what makes scores go up and down, just what drives scores up and down here. So it was an old Charlie Chaplin silent movie that I started in. So where I started here on this whole debts matters how bad and how recent debts are. So as much as it's written in here, if it's an older debt, it does not hurt your credit score as much as if it's something that's currently late today. So the scoring, the bureaus and the scoring model looks at if you're not able to meet your obligations right now, your score will be infinitely less than if it was something that occurred over 2 years ago. So I personally try not to let people beat themselves up by things that happened in the past. We'll only know by running the credit profile how things look. And then once I can see it on paper, what we can do to offer, maybe get the score up. And we'll talk about that here through the course of this Zoom call and increase it for their chance for success. So if any of this bad debt is paid off, it's not going to hurt their score as much as if they settled it and or paid it in full. So all relative. Sometimes they don't even need to pay anything off. They're in the process. I'm cleaning up my credit. I got to do this. You know what? Let's just see where you are right now. And if we're able to offer something great. So the some programs in here with regards to foreclosures and bankruptcies have seasoning requirements. So there might be for the loan you're seeking that we're going to need to get a little time behind that based on when the foreclosure sale hit or when the bankruptcy was discharged. We have programs for lesser than that, so it's kind of relative. The age of the credit profile matters, how old the trade line history is. Somebody that's got a very recent trade line history is going to have a lesser score than somebody that's got a deeper credit profile. The percentage of revolving debt available is a really big one. And we're going to hit on that through the course of this conversation. But even if you have all your debts paid as agreed, and the example that we're going to go through here today is a buyer that had a credit score in the 640s. And we were able to get their score up and increase their purchasing power by $50,000 in price. And their credit's perfect, no lates at all. They had some revolving debt, okay? And where our loans qualify is it goes by the lowest middle score for all borrowers. And these particular applicants happen to be a father-son. The dad's credit was in the mid 700s. The son was the 640s, I think 646 as I recall. And we needed his income. So what can we do to get the kid's credit score up? That was really kind of the initial effort. So this percentage of revolving available, if you had one credit card with a $5,000 limit and you're at maybe a $4,500 balance on that, you're relatively maxed out. You're at 90% maxed out on that account. And your score will be infinitely less, even though it's perfectly paid as agreed. The scoring model looks at credit scores as risk-based. Lower the score, higher the risk. Maxed out on credit cards, more risky than somebody that's not with a conservative credit profile. That's kind of rule of thumb. The success of credit inquiries, days of yesteryear, people used to be very concerned about running your credit. I don't want another inquiry. I don't want my scores to go down. My credit's this, my credit's that. That is old school thought. The government came back into I think it's a line item addendum through the Fair Credit Reporting Act, allows consumers to shop within the same source code. So this source code for us is the mortgage industry. You can shop, the shortest bureau is TransUnion is 14-day shopping. That means within 2 weeks, any inquiry all counts as one under a mortgage debt. Anybody that's shopping for auto financing is all lumped together for one source code. So every time you go to a dealer looking, for what do you have to offer me, or your credits run through the credit union or your branch bank, it's all one inquiry. So that doesn't hold true anymore. Each one of the bureaus calls their scores FICO now. There used to have different names for TransUnion and Equifax, but everybody's FICO, FICO, FICO. A lot of people have this notion, what's your FICO, and they use it. It's almost like a Band-Aid is to a bandage or a Xerox is to a copy machine. Once again, our industry, we're going to use the lowest middle score. And I say predominantly in here because we have a few programs that only care about one score. Some of them may take an average. The overwhelming majority of programs take the lowest mid score for all borrowers. And we've had instances, if you have a husband and wife, where the primary wage earner is at a 750 and the stay-at-home mom or stay-at-home dad is at a 600, I would be the first one to suggest taking the stay-at-home mom or dad off the transaction and not pay the higher rate with the 600 credit score in that example, and structure the loan in the higher credit qualifying applicant and get a better rate and better fees. Both people can still be on title. It's just a matter of the loan itself. The cost for all three bureaus merged on one report for a married couple, $62. And it would be the same for a single person. So married couple or single person, $62. We have this Wayfinder and What If Simulator. We're going to go through that in the discussion here. They're awesome programs, super easy to see and understand for our loan officers and for clients alike. But basically, they allow us to change things on the credit profile and see what the score would go up to, such that are we wasting our time by trying to modify the trade line information? You know, is this just a waste of time, or is there something to it? Is it worth our time and effort? Supplements refers to, and there's no additional charge for it, if a creditor has not reported in the last month or 2 months, lender may ask for that to be updated. Supplement the credit report and show me that that mortgage is paid as agreed in the month of June. They haven't reported since May. There's no additional charge for that. So it's all in the $62 fee. Okay. The Wayfinder and What If Simulator are programs, so they're software programs that allow us to change info. We can run those only if we've run the Advantage credit report in our company's name. I can't take it from another creditor or another credit bureau or credit agency. We do have access to this soft pull, and there are a lot of people that use this term out there. Hey, can we do a soft pull and just see what we've got? So we, like everybody else, we have access to that. What the heck is that? It means that I can look at the trade line history. I can look at the credit scores. It does not allow us to run the automated underwriting, so I can't run it through the system. It doesn't count as an inquiry to the client, even if they don't have anything else in the 14 days. It's only $11. But once again, I can't run the automated underwriting. So if you just want to look at it, and if they decide, hey, we want to move forward, or hey, can we get the approval? Then it goes, up to plus the $62. So it personally, and just what I would suggest to our loan officers, if a client is unwilling to invest the $62, or you can't come to kind of a meeting of the minds for a $62 charge to see what you've got to borrow hundreds of thousands, kind of getting off to the wrong foot. It's difficult when people won't invest in themselves and in what they're trying to accomplish. So this is an example, and we've gone through this in past months, but just a quick example of a credit score in the mid 600s to mid 700s. The difference in rate here is about 0.625% in rate, but for the same 5% down payment and the same principal and interest payment per month, they're getting an extra $50,000 in price for the home. So really, in essence, the higher the credit score, you just picked up for the same, for the increased home value with 5% down, you got a $50,000 additional purchasing power for the same principal and interest payment. So the only thing that's going to be different here, without getting too much in a deep dive, would be the more that you pay for the home, the higher your assessed value. So the property taxes are going to be slightly higher on the more expensive home. Nobody can control that. The more expensive the home and the more there is to insure, your homeowner's insurance is going to be slightly higher. When I say slightly, homeowner's insurance in this price point here could be the difference of maybe like $10 a month, maybe. Depending upon the tax rate, would only tell you how much the property taxes would go up by. Your mortgage insurance is lower with the higher score. So the MI factors are better at the higher score, but this is just an example for just the principal and interest portion of the payment. So you're spot on here within $1 with a $50,000 difference in price. So it gives you power. It gives you also an ability to sweep people off their feet and do things that our competition might not be able and or willing or maybe even knowledgeable enough to do. You know, we're like, I don't do credit repair. Well, we don't do credit repair either. The things that I'm going to go through here in the next half hour or so are super easy. I mean, this is nothing that takes any heavy lifting. So this Wayfinder program, it's through Advantage Credit and other credit bureau or agencies, credit agencies, sorry, is Advantage Credit. The bureaus are the TransUnion, Equifax, Experian. Other credit agencies have the same Wayfinder program. So it isn't proprietary only to Advantage Credit. So other major Credit Technology Inc., Certified Credit Reporting, other major national players, they've got it too. It's a software program basically that has the algorithms through the bureaus to see when information is changed, what the score would adjust to. So it allows us to go with the credit report run and dictate what the score we're seeking with findings. So the Wayfinder, I can put in a number. We want the 640 to get to 700. What do we need to do? And it will show us in findings exactly what we need to do to get there. And there's no additional cost for it. So the Wayfinder allows us to establish a score and it tells us what to do to get there. The what if simulator allows us to go into the credit report run and change anything reported, and the credit scores will be rerun and reflect what the changes are. So example on the what if simulator would be, I got that $5,000 credit card with the $4,500 balance, but I just paid it in full. That's wonderful. What does that do to the credit score? Well, let's go into the what if simulator, modify that data and see what the score would jump up to and see if it's worth our time and effort to get the updated letter with the new balance and go to the extent to do what's called a rapid rescore. So to ultimately increase scores for the sake of loan approval in the D or LPA is Fannie Mae and Freddie Mac's automated underwriting, we need to order the rapid rescore. And it corrects the scores permanently. It isn't anything where if the lender reran the credit the next day or a week later, that all of a sudden everything's going to revert back and we're going to get stuck or in a rock and a hard place. Okay. It costs $45 per bureau per line item. So if it's only one particular line item and only one bureau reported it, it's $45. If all three bureaus reported it, it's $135. So 45 times 3 is $135. When it comes down to increasing your buying power by 50,000 up here, I think for most people, you know, to keep my same principal and interest payment, and you can qualify me for the same principal and interest payment, and all I have to do is spend maybe $135 in order to get an extra 50 grand in price. It's a win-win. There's no doubt about that. I did as a little extra value add, and we've talked about this in the past, but credit scores can also be increased by just being added as an authorized user to another individual's account. So it's just an example. A parent or grandparent has a long-standing paid as agreed account with a good high credit limit, little to no balance owing. By adding as an authorized user, you can build a credit profile and increase scores. So it's going to pick up the age of the credit profile. It's going to pick up it's going to dilute if you're maxed out in your other trade line history. So if I had the same $5,000 card with the $4,500 balance and you're added with a $20,000 high credit limit with no balance owing, well, now my revolving credit limit is the 20 grand I added plus the 5 grand is 25, and my balance owing is only 4,500. So I'm below 20% usage. Where if I'm not added to this 20,000 and I got the $5,000 limit and 4,500 owing, I'm 90% maxed out. So your credit score is different based on the revolving debt available, the percentage of revolving debt available. The authorized user is not a rapid rescore. So that would be something where we'd have to be a little ahead of the curve and realize if you want to do this, let's add you right away. And we're going to need to wait. If it's right at the end of July, I couldn't do it quick enough here before month end, such that when that creditor reports in the month of August, that authorized user account would show on the new credit borrower as a new account, and it would pick up immediately with the trade line history and the like. And as odd as it is, you could have a credit card that goes back. I'm trying to think of the old J.C. Penney or Sears, or you could have an date open 1995 from a parent or grandparent, and the borrower was born in 2000. It's still going to apply, even though the date opened is prior to this person even being born. As long as it's on there, it builds credit. So on this particular Advantage credit profile here, this guy's first name is Andy. So Andy's got a 646 mid credit score here with Experian. So once again, we're not taking the high, we're not taking the low, we're taking the mid. And on the first page of the printout, they tell us on every single one the potential score improvement, which is a lot. So plus 96. That's to get to 742. That's a lot. 646 to 742. Like, I mean, in fairness, tell me more. Like, how the hell do you do that? 650 plus 70, 720. So conceivably, this one goes to 705. Once again, we only need the mid score. So sometimes if the lowest score is kind of a dog, I could pay for extra rapid rescores, an extra, $45 per line item per bureau, and spend an extra $135 for everyone in the Equifax. But I'm only concerned about the middle credit score up in here. So for thinking smart, I could be a 615, 800, 800, and we're an 800 for scoring. 615, 713, 714, we're 713 in that example. Okay, so I'm not too worried about the lowest score. So this just gives us immediate info as soon as his credits run. This is the first page of Andy's credit profile. Okay. And in the scores in here, 646 credit score right here. That's his mid. Underneath each score, they tell you what they call score factors. These are things that make the score go up and down. So with Equifax, the first score factor affects the score the most. Length of time accounts have been established. That means he doesn't have a very deep credit profile. The second one is proportion of balance and credit limits is too high in bank revolving and other revolving accounts. That means maxed out in your credit card debt. The TransUnion, number one score factor, proportion of balances, credit limits on revolving, maxed out in credit card debt. Experian, first one, ratio of balances to limits on bank revolving, credit card debt, or revolving debt, maxed out. Okay, so it's telling you, hey, these are the score factors. Okay, well, it's just general info, but that appears to be, there's nothing in here that references you have derogatory credit or public records. Public records would be things you go to court for, judgments, tax liens, bankruptcies, things of that nature. So when we flip through Andy's credit profile in here, the very first account that shows in the trade line history is an installment debt, which means fixed rate, close-ended payments. It's a 60-month term. The payment's $261 a month, and he owes $89.56. So from that standpoint, okay, you got a fixed rate debt, you owe $261 a month. This is not revolving debt, so this does not affect the score as long as it's paid as agreed. This is a brand new debt, just opened. It's only this month reviewed over here is only 1 month. So it has no bearing on the age of the credit profile. It needs to be included in him qualifying. So we got to add the 261 in there. In the mortgage industry, if you have less than 10 payments left, we wouldn't have to hit him for that payment at all. So like most car loans are between maybe $500 and $600 per month. Let's say this is a car loan and the payment was $600 a month. That means the balance has to be paid down below $6,000, which is less than 10 payments, in order for this debt not to be included. So if this was $600 and the balance was $89.56, $29.56 would pay it back down to $6,000. $29.57 would get you so they didn't have to get hit with that payment. So it doesn't necessarily mean on some installment debt that you have to pay it in full. It just means you got to pay it down to a balance less than 10 payments. Okay, so there's like a little nugget right in there where maybe we can get them in and they can qualify just by applying a little bit of money. pay that debt down, man, done. We don't have to hit you for that payment. Maybe that increases their buying power. When you look through here on this first revolving account here is through Apple Cards, the credit limit here is $4,000 and the balance owing is $38.77. So this one's pretty maxed out. Who's kidding who? If you go to a calculator, the $38.77 divided by $4,000 is 97% maxed out. They have $123 available before that. This is already capped and you can't borrow anymore. So that's why the score is what it is. Same with this Bank of America card here. Credit limit's $2,500. Balance owing is $24.54. That equates to 98% maxed out. Is what it is. This one, this is a medical payment. This looks like probably they went for some medical procedure or something, and maybe they set up on a revolving account. Could be, your local dental office, or, I couldn't afford the treatment that I got, and they carried the financing in the doctor or dentist's office. Super common. This one's not that maxed out, but these two sure are. This one here with Capital One is a revolving card. The credit limit's only $600. Balance owing is $441. So even though the balance owing is very modest, it's still, when it comes down to a percentage revolving available, that one's at 74% is what 441 divided into 600 equates to. This one is no balance owing, so you pick up a good, high credit limit. Same with this one here with Capital One. And then we come down in here, there's no derogatory accounts, no public records. That means never a late pay, perfectly paid as agreed. So you're telling me somebody that has an account history, and this goes back as early as trade line in here, is open 10 of 2018. So it's arguably 5-year credit history, perfectly paid as agreed, never a late pay, and his mid-credit score is 646. So looking through this, and in our reviews of everything, any questions that people have with regards to things on their credit profile, we can get telephone numbers. They can call any creditor that they want. So I'm going to go through here and just explain on this Wayfinder.
I have a question for you, Greg.
Yes.
Is it, I've heard before that that things fall off after a certain amount of time. Is that true?
Okay, so most of the statute of limitations is 10 years. There are instances, and I was just talking, Georgina Bolton is one of our very successful dual agents. And I was talking with her this morning. She's struggling getting an FHA loan approved, and she's going through the findings with me. And in 07, 08, they went through a foreclosure, and FHA got burned on a FHA loan. And so the government loans that are out there, even though it's past the 10-year mark, that client can't get another FHA loan. It's kind of that old adage, burn me once, burn me twice. If they got burned once, they're not going down that path again. So that particular client is stuck, even though it doesn't even show on the credit. It doesn't even show on the credit profile. She's like, where is this coming from? So sometimes you can get, and it's the same with VA entitlements. So VA, the same, burn me once, burn me twice. And if you had a bad debt, did you get it paid? Did it get settled? You can have a short sale, but did they agree to take the amount less and call it to zero? And it's the same on anything. You could settle a collection account, charge off, car repo. Maybe they didn't get every dollar back, but if the creditor said, you know what, thank you for at least, getting me whatever you can, I'm cool with it. And if they're in agreement to settle for a zero balance, then none of that would affect you. So there definitely is a statute of limitations. Here's one other thing, though, that I'm mentioning about that, Rochelle, that sucks, is that, and this is just the reality of things, is there are people that think, oh, this is eventually going to fall off. The creditor knows also that it's going to fall off your credit profile. So what happens quite often in the credit world is people sell off bad debts and they sell it off to a collection agency. So the collection agency might be working with Toyota Motor Credit, Honda Finance, or whoever, and they had a bad debt and they didn't get paid. They had it on the credit profile. It's nearing that statute of limitations. It's going to fall off. The creditor that couldn't collect on the debt then sells it off to the collection agency. The collection agency buys it for pennies on the dollar. maybe 5 cents on the dollar, 8 cents on the dollar. And they look at it like, hey, I'm willing to pay something, but now I have the right to collect the money. So what it does is it restarts that statute of limitations. The credit agency now has date opened and they're chasing you for the money down the road. So it's not uncommon that thing's just like, I've had some people that are just like, are you kidding me? No way. They can't do that. Yeah, way. And yes, they can. So, I mean, it's just a mean, cruel world, but the collection agency looks at it like, hey, if you think you can put your head in the sand and never pay this until the day you die, have at it. But maybe I'm willing to take a chance. And if that balance owing was $10,000 and 5% of that is maybe $500 for the right to collect the 10,000 and the collection agency tax on their fees to collect it, at some point in time, even if you settle for me for $5,000, which might be 50 cents on the dollar, I'm still way ahead of the curve. I paid $500 for it and I just got $5,000. So win-win for them. And in the world of collections is ruthless. So it's difficult on some of that stuff. Bankruptcies, they can't rear their ugly head again. So that's going to go away. So is the bankruptcy eventually going to fall off? Yeah, absolutely. It's not like you can sell off that trade line, but it is, there are a lot of sneaky, methods that are out there that get, that thing, just rearing its ugly head. So I'm going to go back to the shared screen here and I'm going to click into the Wayfinder. I'm going to look at it with you. So this is Andy here. And as soon as I popped into his Wayfinder, hopefully you guys are seeing the screen. If you're not, holler out at me. I'm going to click on that. I want it plus 700. I can put in anything I want in here. Let's shoot for the moon and the stars and a plus 700. Did you see the new screen that goes to 94% likely, or did I have to stop and reshare? You guys seeing this 94% likely?
We can see it.
Cool.
Yes.
Okay. So let me just expand this. So this is just one bureau. And it's saying, hey, we found a way to reach 700 or higher. And you got to use $5,912 of your money. And this is in the attachments that are in there. If I click on see details, it tells me exactly what needs to happen. This is what I printed up and I put in the attachment that was emailed out. Okay, so very simply stated, if you took the Apple card and you paid this way down and you took the Bank of America card and you paid it way down, your score is going to jump significantly and you got a great chance of hitting the mark. And same with this TransUnion. I can do the same thing with TransUnion and see details, and it's going to go through very similar. TransUnion was 67.72, but now I can increase my credit score by 100 points. So let me get back to here, stop, share, bam, bam. So back to this printout. This was 67.72. So you'd come back like, yeah, that's a lot of money. You can get the money from anybody. You can run these cards right back up after closing. So it isn't anything that's like, well, no, I mean, it has to come. This is not sourced in seasoning funds like a standard purchase transaction for FHA or conventional loans might be. Like, hey, where did that money come from? Hey, what's going on? Hey, how did you get that? This is nothing, well, it's got to be in the bank for 2 months. No, this is money that falls out of the sky, pays the debt down, gets the score up, move on with your life. So it literally could be a short-term float from any friend, family, or otherwise, or money that people have, and at the end of the day, this is your own debt. This is Andy's debt. And Andy G is our guy here, but nobody's charging Andy any more in fees. Nobody's saying, sticking it to all we're suggesting is, hey, if you had 67.72 and you did this, and this, easy as 1, 2, 3, ABC Jackson 5 style, it's easy. And you get your score up 100 points. And you increase in that example, the buying power went up 50 grand for the same P&I payment, principal and interest. Is he eventually going to want to pay this debt down? Probably. These creditors would hope that he'd tread and pay minimum payment for the rest of his life because they make a stupid amount of money on interest. Most of the credit card issues are out there at 23 to 29%. Overwhelming majority. They would hope that he didn't pay it. All he's doing by paying it is just foregoing paying undue interest. Could you go to the extent to pay it down, take a short-term loan from a friend, family, coworker, or otherwise, pay it down, and then post-closing, go back and take a cash advance and draw the account right back up after the fact? You could. Nobody's underwriting the loan post-closing. So it isn't one of these where you get the house key and then 30 days later, we got to run your credit again. We got to make sure everything's in order. Get me some more updated pay stubs. Let's make sure your job is still intact and we got to reappraise the house. No. You got in, you qualified at the time of closing, move on with your life. And nobody can take away the terms of the note.
I have a question, Greg.
Yes.
So for these for the borrower pay off these, do they pay it off at closing, or do they pay before they
It needs to, here's a great question. It needs to be paid up front such that we can get statements or a letter from this creditor on their letterhead showing the new balance. And it might be that they only reference, a lot of these companies now will give you the XXXXX with only the last 4 digits on the credit. You're awesome. And that's all we need. We need the person's name on it, the last 4 digits on the account, whatever the updated balance is. We then send it in for the rapid rescore. The rapid rescore is what gets the scores to go up. And that only takes 48 hours, 72 hours max. So within 2 days of ordering the rapid rescore, your scores jump. And with that new credit profile, now we can run the automated underwriting. Now I can get the pricing that you would otherwise want. Now I can get you into the lower rates and lock in the lower rates and increase your purchasing power. So this is not, that's an excellent question. This is not something that can be done all the way down at closing. So if you want your score to, go ahead.
I have a question. This is Ted.
Yep.
Can you do this on your own? Like you can go on a website and then I'll give you instructions how to kind of.
So here, that's also excellent question. So any borrower could pay down their debt, not use that card, and wait for the creditor to report the current information on the subsequent months. So you could go to the extent to say, you know what, I'm going to pay down this $38.77. I don't want to have to pay for rapid rescore. Let's say all 3 bureaus reported it. That's an extra $135. I'm not willing to do that. You could go to the extent to pay that debt down or off to 0, wait for the next calendar month to report the current info, rerun the credit, and see what that score goes up to. The twist with when the creditor will report in the calendar month is they don't disclose what day of the month they report, nor is it the same day every month in, month out. So we would be kind of just in limbo waiting, like, is it done yet? Is it $62 for the credit? If we pay it this month and then I say on August 15th, well, we got about a 50-50 chance it's already reported. Let's run the credit. And we run the credit and we paid the $62 and they haven't reported yet. Like, well, it still shows, let's wait again. And we get towards the end of the month and like, hey, let's run it again. Well, now we spent $124 running 2 sets of credit reports. Maybe by the end of the month, it's already reported and done, but we just lost a calendar month. And it's like cutting off your nose to spite your face. We saved $135 on the rapid rescore, but yet in that example, we paid an extra $124 in credit reports.
So I guess, Craig, my question would be, do you have to use a company that does the rapid rescore, or could you just go on a certain app or,
So the only other way other than the rapid rescore would be to pay off or down the debt and then wait patiently for the creditor to report to the bureaus and rerun the credit after the fact. That's the only other option. So if you're at a point where, let's say this is a great example. I'm in a new build. Property is going to be completed in October. You got a lot of time in your hands. We're not at any point we could submit the file towards the end of August or September 1, no problem. You had the money to pay off or down the debt, pay it off or down. Let's update the credit at the end of August. Hope that everything shows and is correct. There are creditors that at points in time, it's not by law, they have to report month in, month out to the credit bureaus. So that first little notion or note that I mentioned about the credit supplements are included with the cost of the credit report. If the creditor did not report on that calendar month, then we need to go right back and do the rapid rescore anyway. You're like, what the heck? How come you didn't report? It's not like, well, I'm going to sue you. You know, I can't believe you didn't do this. You know, there are instances, and sometimes in mortgage loans or car loans, and we run the credit report in the month of July, and the last month reported was May. Well, why didn't you report June? Like, what the heck happened there? So it's not a given that the creditor, you know, is you know, there are errors that occur on credit reporting. A lot of credit unions don't report at all to the bureaus. They don't want to employ a customer service division because there will be errors. Capital One, on that Capital One Visa card, has one of the highest, most issued credit cards anywhere. And the last time I heard, I think there was upwards of like 17, 18 million Capital One Visas issued. There are even people living abroad that have those cards. So if you took, and I think the number, and they were really touted as having a great, when it comes down to the errors in reporting. But if you had 18 million issues, and as I recall, I think the number was down to like 4% or something like that. Was there errors month in, month out? Is the error 96% of the people reported correctly? It's about a 4% factor. But if you had 18 million issued, 4% wrong, that means 720,000 people every single month are getting screwed over by incorrectly reported info or misreported info, which is still like, you know, hopefully you're not in the 720,000 and you're in the other 18 million. And not just one silly example. But so, yeah, just from the standpoint of getting it done, you know, you could do all this stuff on your own. The rapid rescore is just a really quick fix. You know exactly where you stand. For most people, time is of the essence, and they don't want to sit by and wait. The other one in here with regards to Experian, also 94% likely. This Apple Card pay down here and the Bank of America pay down here, these are duplicates of the other Wayfinder findings. So we only needed to do the one thing. So if they had the 6772, we could get the debt paid off. You can get into a higher priced home for a similar payment, qualify for more. And at the other side of that, I mean, you're getting a better interest rate. You're paying less money in interest over the life of that loan. That's a better deal for the client all the way around. I'm going to go back and show you the what if simulator here. So bear with me for a quick second. Let me stop the share. Share here. So this what if simulator. This is the TransUnion score, 650. And as soon as I click on it, it shows the balances of all the debts. So this first one in here was the car payment. Okay. The next one in here was this Apple Card, 4,000 limit, 3877 owing. Let's say what if simulator is, what do we need to do? Give me the roadmap. The what if simulator is equivalent to punching in the address you want to go to in your navigation system, and your nav system giving you every single turn to get there. You know, fastest route. I mean, it blows me away that they can pinpoint your arrival time within a minute or two, you know, barring any unforeseen accidents while you're on the way. So they're really, through Google Maps and the technology that's out there, is unbelievable. So the Wayfinder, assimilate that to the nav system in a roadmap. The what if simulator is, hey, the stuff that's on there isn't correct. You know, that Apple Card, that's through my business. And I had to do a personal secure on it, but I get reimbursed for that every single month. And that 3877, I've already gotten the money, and that's paid zero balance. I can take that information and I can go into the what if simulator. I can back out the 3877. Once again, up here, I'm at a 650 score. I can put this in and say, hey, it's paid zero, tab through it, and I just got to 673. And this is something that's already occurred. This Bank of America, now all of a sudden, well, wait a second here, this Bank of America, I pay that off every month. I use it when I need to use it. I run it up. Maybe you get points or some other travel credits or whatever it is. You know, this one also paid to zero balance. I'm at 673 with just the company card, my example, paid off. If this one also is paid to zero, tab through it, Now I'm at 692. You can do the exact same math with any of this stuff. Paid to zero, 696. Paid to
So
zero.
so anybody can use this credit simulator, the
This what if
Wayfinder?
simulator is available to our loan officers when you do business with our company. We utilize Advantage Credit for our credit agency. It's got to be a credit report and Advantage Credit's report. It can't be from another company. And then as soon as we run the credit, I can go into the what if simulator and I can start playing with the data and change it to whatever I want to change it to. So I can go in and I can modify anything that I want in there. And I can see, does it make sense for us to do this? Does it make sense for us to jump through these hoops? You know, what does the credit go up to? Sometimes they're giving me information where it's like, you've already paid it off. I mean, so there's no additional payoff. All you need to do is just get the updated statement letter from the creditor, which is free, to show it's a zero balance. And then we're looking at the rapid rescore in order to get it up right away. So it's kind of relative to whatever we've got in there. If they had a collection or a charge off and they had a letter that shows the collection or charge off was deleted and it was reported in error, I could go in and delete the collection or charge off and see what the score goes up to. There have been instances that the collection or charge off could be a small balance. And then we go in like $300. We go in and show, hey, wait a second here, that's paid off. We go into the what if simulator, we show it to zero balance and it reruns the score and it doesn't affect it at all because the collection account's outside of 2 years. Then it gets into, why would we be paying for a rapid rescore and we get no increase in the score? You know, that wouldn't make any sense at all. So the what if simulator and Wayfinder are tools that our loan officers have that can change the data and see what the score would go up to. And then we can go to the extent to reprice it and say, hey, if we get the score to this new number, what do we get? You know, what is the benefit to the borrower? Is it material? Is it something they want to do? You know, sometimes we offer things to clients and they're like, yeah, thanks anyway. You know, there are things that, you know, you could walk by like free offers. People give you like a free, what would be an example? Like a sample of something. You're at Costco and testing samples. Like, would you like this? Would you like that? Some people are like, oh, no, thank you anyway. Other people sit there and said, man, I came here for a meal. Like, how many can you give me? So it's all like, some people pass on stuff. Other people say, man, I'm all in. That sounds great. You know, I really like that. And then they hang out, they make conversation. They have like 3, 4, 5 samples. Who cares? So, you know, sometimes there are little, you know, tools or tricks we got in the toolbox. Some people gravitate to them and say, hey, that makes a lot of sense. You know, and it might be the difference of them, you know, at that $750 price point, maybe they're looking at homes like everything that I see in the price point that you're telling me for what I can afford in payment. And many, many borrowers out there have a certain number of, I want to keep my payment to this number, which I get. You have a certain budget. I have a lifestyle. This is what I can afford. That's great that you're telling me, hey, you can afford like $5,500. I want $4,500. That's it. Then I'm driving the pricing into, what do I get for $4,500? It backs into this number. Well, would I be able to get a higher price if I had a lower rate? All day long. So how can I get a lower rate? Increase the credit score. You know, now it gets into, when you're looking at homes, I think anybody on this call that's looked at MLS one time realizes that, oh yeah, the homes at a higher price are a lot nicer than the homes at a lower price. Who's kidding who? I'm not going to even like belittle the professionalism of people on the call, but yeah, you get into, you know, and sometimes you might lose buyers altogether that come back and say, there's just nothing in inventory that I like. You know, it's just, maybe it's not the time for me, you know, in comparison to taking a step back and saying, you know, well, you know, what can we do to get you into a higher priced home? You know, how does that work? So just from the standpoint of you know, looking at options, you know, piecing together and really partnering up to stretch. to offer the best of the best and putting our best foot forward. That's really what it's all about. I've talked to some clients with our loan officers over time and agents alike, and they're just looking at like, I've worked with other companies over the years. This is my second or third home purchase. I've never had anybody say this before. I've never, ever, like, what are you talking about? It's just a completely new concept. And I'm not saying we do this with every borrower. If I ran credit for somebody, their mid-credit score was 768, you're set. No problem. If I was struggling to qualify you based on your income in relation to debt, and you came back at me and said, hey, this is reported in error, then let's get it cleaned up so I'm not hitting you for debt that shouldn't exist. That debt's paid off. You're fine. Or we had an installment debt. We wanted to pay down less than 10 payments. Here, let's just pay this down a little. You don't have to pay it off in full. We just need to pay it down just below the 10-month payment threshold, which as simple as that is, if you took the payment, you added a 0 at the end of the payment and minus $1, that's less than 10 payments. So adding a 0 would be 10 payments to the payment. But like I say, for anybody, if you got anybody that's fence sitters, sometimes the trainings that we do, I do it purposely, not only to educate people, but also, it's like kind of thought provoking, think back of like how many people I've had over time where, this particular person, what can I do to get him under contract? It just seems like we're just miss. Is there anything out there, any other option or opportunity that we could do to get him into a better deal? And it is amazing to me sometimes when families, some people out there would say, oh, I can't ask my parent or my grandparent to help me. Or they're not going to give me any money. You can settle up debts outside of the transaction and then get repaid whenever it's convenient. Like I say, you could pull the cash advance post-closing, whatever the case is there. But, the fact that Andy had a 646 credit score and no late pays and relatively speaking, modest debt, you just didn't have big credit limits. Last little nugget there to increase your scores is you could contact every single creditor and ask for an increase to your high credit limit. That's not a rapid rescore. That would have to cycle through to the next calendar month. But if you contacted every creditor, in that example, we looked at Andy and he had a $2,500 credit limit on that one credit card, and the balance owing was $2,454. If he contacted that creditor was Bank of America and increased the credit limit to $5,000, now he's below 50%. If they increase it to $6,000 or $7,000, now you're diluting the balance is not as high to the credit limit. So that's another little like easy quick fix if the creditor will increase the limit. And most creditors out there, especially for somebody that pays their bills perfectly paid as agreed, would hear and say, yeah, you want to borrow more money? Have at it. Use as much as you want. Sometimes creditors increase the credit limits without people even asking for it. Now, I've had some clients like, why did they do this? Those dirty dogs, they're just baiting me to use more debt. The reality of things is all it did was increase your credit score by increasing the credit limit if you're using that account. So as long as you're modest in the usage, you're all set. And it's a win-win. All right. That is all I've got for today. As always, and I put on that front sheet my email address and my cell phone. But you got any questions or anything that pops up? Happy to look at any scenarios that you've got. And I can even kind of look at scenarios with somebody else's credit report and maybe have an idea as to what, and give you my quote unquote 2 cents worth. But the other side of that is, in the beauty of the Wayfinder and What If Simulator, is it comes out in their with their trademark logo on it. So if you go back to those last pages in the attachment I sent, the credit expert for the Wayfinder, it's not Greg telling you what to do. It's not loan officer 42 that's in cubicle 13 in the corner that's telling them what to do. It's coming straight from that software program on their letterhead. So it kind of, I'm not going to say gives more credence or value, but at least it's not one person just kind of speculating. I think it would be this. All right. You guys are awesome. I appreciate it.
There he goes. Good job, Greg. Really appreciate it.